I'm sure many of you have been hearing more and more about the Fed and the updated inflation news. Everyone is concerned about when the Fed will raise interest rates, so let's jump right into the Fed report and look at the numbers ourselves. So we're going to go through some of the economic factors the Fed is looking for before they raise rates. The Fed wants to see maximum employment before they consider raising interest rates. They actually want to see maximum employment across all race groups, meaning that employment for this diverse group of people will need to be at pre-pandemic levels before they raise rates. The latest numbers we have are from June, where the unemployment rate was 5.8% versus 3.7% in 2019. That means we need to cut unemployment by 50% before we hit those targets. So when does the Fed believe the job target will be hit? Well, if you look at this graphic on screen right now, you see that many of them believe that the number will be met around March to June of 2022. Okay, so we now know the Fed is thinking that the first rate hike could be coming around March to June of 2022. We know that the market does not like rate hikes, especially quick and large changes. Luckily, they provide this data for us. Now, the consensus isn't as daunting as the media makes it out to be. The majority of Fed members believe that interest rates will stay at zero through 2022. 61% of Fed members believe that rates will stay at zero, while 88% believe rates will stay below 0.5%. Then in 2023, 28% believe that rates will be held at zero, with 77% predicting rates below 1% through 2023. And guys, if you could take a moment to just slap that like button real gently, please, that would be truly really helpful with the YouTube algorithm. The number one question I have heard from those who look at these numbers is, so you're telling me that if we see good job numbers, they will increase interest rates and we will see a market crash? Well, this is a very good question to cover. You must understand that if the criteria for raising interest rates are met, so strong economy, maximum employment, slowly raising interest rates will not cause a stock market crash. The concern is that some people believe that the Fed is underestimating inflation numbers, and they believe massive inflation is coming, and the Fed will be forced to raise interest rates swiftly. We did cover the recent inflation numbers in a video from last week, so if you want to check out that video, I encourage you to do so. But why did the market respond so negatively to the Fed's comments? The Fed gives us updates on their predictions month to month, and they show a comparison of what they currently think versus the previous period. These charts show the Fed's predictions for interest rates in 2022 and 2023. The dotted lines show their prediction from March of 2021, and the solid blocks represent the current predictions. The panic that we saw on Thursday was caused by a small shift from some members showing that they changed their mind and believe that interest rates will rise slightly quicker. While the predictions were being made this month, I was not concerned by these numbers. If interest rates can stay below 0.5% in 2022 and under 1% in 2023, then I believe that will mean that inflation is present, jobs came back, the economy is still doing extremely well, and things are going in a solid direction. We may indeed see the market throw a hissy fit when rates are first raised. I believe that can be expected at this point. The key thing to look out for is how the raise in rates will impact spending and the economy. If the economy is truly at a healthy point, we should be able to handle interest rates under 0.5% in 2022. So now that we have covered the data from the Fed report, let's go over Jerome Powell's press conference. Jay Powell was a lot more aggressive in this press conference, and this caused some nervousness in the market. So interest rates will be kept near zero, and the Fed will maintain their asset purchases. Tapering won't begin until data shows progress towards their goals. When the data is shown, they will announce a timeline for tapering asset purchases. Vaccinations and fiscal policy are providing strong support to the recovery. Economic activity and employment have strengthened quickly, with GDP on pace to track its fastest rate of increase in decades. Household spending is rising at a rapid pace and being boosted by the reopening of the economy. In some industries, supply constraints are impacting their activity, with this being a bigger issue than many originally realized. These bottlenecks have limited how quickly production can meet demand and increased inflation more than they originally anticipated. As the supply bottlenecks go away, inflation numbers are predicted to fall to 2.2% for 2022 and 2023. Unemployment remained elevated at 5.8%, with issues such as caregiving, virus fears, and unemployment insurance payments weighing on employment growth. As these factors wane, a rapid gain in employment is anticipated. Despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. When asked about the high inflation numbers seen the past 3 months, Powell used lumber as an example of what the Fed is predicting. Lumber prices skyrocketed due to shortages, but are now rapidly falling as supply is increasing. Used cars accounted for 1/3 of core inflation increase in May, and that is expected to come down just as lumber has. If you're looking to join an awesome stock and crypto community, be sure to check out our Smart Money Patreon. You're going to get the alerts that you need to gain an edge in the market. Early stage exponential ROI projects like these will be called out so you can get in before everyone else. So if you're interested in that, the link to sign up for the private Discord and Patreon is in the description, so be sure to check that out. Wrapping up his speech, Powell said that it is a heck of a lot easier to create demand than it is to bring supply back up to snuff. We are seeing that all over the world, but we have no reason to think that that process will last indefinitely. While many people are staying away from giving their opinion on the latest Fed report, Jim Cramer is one who hopped right in and gave everyone his opinion. So Jim Cramer believes that Jay Powell did a great job and is handling everything beautifully. Jobs are coming back fast and strong, and companies are crushing earnings. As far as how to adjust your portfolio, he suggests to do nothing.
Well, guess what? Like I said on Monday, if you're nimble and you like to trade, you can take something off the table, as long as you're ready to buy it back before the end of next week. The charts say don't buy, don't buy. And I give them more weight than the spots and dots that everyone's obsessing from for the Fed. I took that course, by the way. I aced it. Now, second, the Fed basically did nothing today except take itself out of the equation for the next 6 months. That was it. That means you should buy stocks that can deliver better than expected earnings in a low-rate environment.
If you are a trader, you might see some sorrows in June, but past that, there is no reason to think that there are concerns immediately ahead. He also believes Powell is doing what is best for the average person, and that the wage hikes we are seeing are a good thing long term. He says demand for goods is very high, and people are spending without taking out debt, both very good things. Cramer wants to see if the sources of the inflation will go away naturally, without tightening, which would be much better for the market. Cramer says that Powell thinks much differently than the previous Fed chairman, as he believes that we can have strong job growth and strong spending without causing too much inflation. If this is indeed the case, this is a great time to buy stocks.
Stocks that can deliver better than expected earnings in a low-rate environment. The reporters are all trying to get Powell to commit to some silly timeline, some timetable that would wreck the economy and probably not stop inflation. He's not playing that game, though. He wants people to make a little more money. Who said wage inflation is a bad thing? Most people, except CEOs in this country, are underpaid. He knows there are imbalances in the economy, shortages, because business didn't realize we beat the pandemic this quickly, and there's been a huge amount of stimulus. But as Powell said, and I quote, there's a big group of unemployed people, end quote, and he doesn't want to leave them behind just to please billionaires, oligarchs, kleptomaniacs, and useful idiots in the media who want higher rates.
With the Fed taking themselves out of the equation over the next 6 months, tech and industrials have plenty of time and room to run. He believes that the negative sentiment from the experts is because they can't grasp that Jerome Powell is not one of them and learns from his mistakes.
Powell believes we can have some key lime pie and have a decent size, but not too big piece, smaller piece. If that's the case, then I think you should simply stay the course, maybe using this decline to buy some high-quality stocks, especially industrials, right into the teeth of a downturn we anticipated here with the help of Larry Williams. With the Fed taking itself out of the equation for at least 6 months, maybe longer, the industrials have a lot more room to run. By the way, I include the technology stocks with the industrials. The problem right now is that the experts, from the economists to the reporters who follow the Fed to the hedge fund managers who trade off the Fed's moves, see, they just can't seem to grasp that Jay Powell just isn't one of them. Never mind that he was a private equity guy. He's like no other Fed chief I can recall. Powell actually learns from his mistakes. In 2018, he listened to the inflation hawks and spoke glibly about the need for 3 rate hikes. That blew up in his face. He quickly had to change course. Since then, he's approached his job with a sense of humility. He reiterated that today. He knows that it's hard to predict what the economy will do. So he wants to err on the side of a strong labor market, even if it means we have a little more inflation.
The other key part of Powell's plan that no one talks about is black unemployment. Powell feels like the high levels of black unemployment must be dealt with before they can raise rates, and that no ethnicity should be left behind in this recovery. Powell will not let the working man take the hit, and he sees this short-term inflation as a necessary evil. Cramer believes that the right moves are being made and that there is a key part of the Fed decision that people are conveniently leaving out. Thanks for watching, and invest smart.
Just do it! Yesterday, you said tomorrow. So just do it!